studio microphone, podcast script. Chart decreasing the collapse of tech stocks. A trader's research brief. Host. Welcome to Trader's Research Brief, the show where we break down the week's most critical developments in the markets, blending hard data, sharp analysis, and a trader's instincts. I'm your host, Name, and today we're tackling a topic that's been shaking portfolios and shifting entire sectors: the collapse of tech stocks in late 2025. We'll dig deep into what's driving the crash, the overvaluation of artificial intelligence, the fragility of AWS and cloud dependence, and the macroeconomic shocks rattling big tech. We'll also dive into the bear and bull cases for three high-profile names: Tesla, IBM, and Salesforce, and explore the lessons revealed by October's massive AWS outage, which exposed systemic risks hiding in plain sight. As always, a quick note before we start. This podcast is for informational purposes only and does not constitute financial advice. Always do your own research or consult a professional before acting on any investment ideas. Let's get into it. Segment 1. Setting the stage. How did tech stocks collapse? Before we break down the reasons behind this collapse, let's contextualize what happened. In the last quarter of 2025, the tech-heavy Nasdaq plunged, erasing trillions of dollars in market value. Big names that once seemed untouchable, Nvidia, Amazon, Microsoft, Alphabet, Tesla, found themselves in sharp reversal. This shock didn't happen out of nowhere. It's the product of several converging forces: a speculative surge and subsequent loss of faith in artificial intelligence markets, overdependence on a handful of cloud providers, Amazon Web Services in particular, a cocktail of macroeconomic pressures, stagflation fears, rapidly rising debt, tougher rate environments, and faltering consumer demand. Growing concentration risk. Over half of S&P 500 returns over the past 5 years were driven by just a handful of mega-cap tech names. What made this time different? Let's break down the pillars underpinning this collapse, starting with the most hyped and hazardous: artificial intelligence. Segment 2. The AI bubble, from boom to bust. Let's start with what many are calling the AI bubble. Beginning in 2023, we saw an extraordinary surge in AI-related spending, data center build-outs, massive chip orders, and a sense that every business needed to brand itself as AI-powered just to stay competitive. But by October 2025, cracks began to show. Investor skepticism spiked amid damning stats. 95% of enterprise generative AI projects failed to deliver meaningful returns. The top AI chip and cloud infrastructure companies, Nvidia, Broadcom, TSMC, AMD, hit valuations well above historic norms. OpenAI, arguably the poster child of the AI gold rush, needed $125 billion in revenue to break even, but continued to burn billions every year. AI investments were funded less by operational cash flow and more by debt and circular financing deals. Nvidia investing $100 billion in OpenAI, which would then spin it back on Nvidia chips. The same logic fueled deals between AMD, Oracle, Microsoft, and CoreWeave. This tangled web of cross-investment is eerily reminiscent of dynamics seen during the dot-com bubble. Instead of solid business models, we had sky-high price-to-earnings ratios: CrowdStrike P/E of 401, Palantir 501, massive debts, and little evidence of sustainable AI profitability. So what actually popped the bubble? Several things. OpenAI's inability to continue raising cash, threatening a bankruptcy cascade through the AI and data center ecosystem. Slowing venture capital flows, with AI investment velocity declining below the $193 billion 2024 record. Concentration risk. Nvidia relying on two mystery customers for over 40% of its revenue. Rising debt service costs at CoreWeave, Oracle, and others, echoing the telecom bust of 2000. A critical shift in market psychology, triggered by poor quarterly earnings and, perhaps, a high-profile burnout list of companies at risk of running out of cash. Why did investors keep pouring in until now? For a while, the narrative made sense. Enterprise AI adoption would soar, and mega-cap techs would turn those investments into durable cash flow. But data from MIT and Morgan Stanley made clear AI wasn't paying off for most enterprise users, and the AI arms race was built on unsustainable debt and circular revenue recognition. Segment 3. Cloud Fragility. The AWS outage is canary in the coal mine. Sound effect, chime, or server beep. Music bed shifts to a tense undertone. Now let's pivot to the cloud, the beating heart of digital business and the backbone of AI processing. In late October 2025, the unthinkable happened. An AWS outage in its U.S. East 1 region, Amazon's largest and most critical data hub, sent shockwaves through the global internet. For nearly a day, the outage disrupted over 3,500 companies, including banks, retailers, airlines, and social platforms. Delayed financial transactions, crashed consumer banking apps, locked out warehouse and delivery workers, and even affected internal Amazon operations. Impacted critical government agencies in both the U.S. and U.K. Yes, even defense and tax authorities. Highlighted that even redundant, hyperscale cloud systems are vulnerable to single-region failure. Industry insiders call this a digital pandemic. But the real lesson wasn't just about downtime. It was about systemic risk. Almost all modern tech, finance, health, government, logistics, runs through a handful of cloud zones owned by Amazon, Microsoft, and Google. When one fails, the blast radius is global. AWS outage showed that complexity can outpace resilience. Key services depended on U.S. East 1 for authentication, control, and data flow. When a DNS fault hit DynamoDB in Virginia, failures rippled worldwide. Even companies using different AWS regions or multiple platforms were affected via hidden dependencies. Why? Because the promise of distributed systems had, in practice, become a centralized, fragile monoculture, rewriting the early Internet's founding principle of decentralized resilience. Segment 4. Macroeconomic shocks, the final straw for tech valuations. If the AI bubble and cloud fragility set up the dominoes, macroeconomic shocks knocked them down. Here's what traders were navigating. Persistent inflationary pressures. Producer prices rose faster than consumer prices, squeezing tech margins and challenging companies to choose between raising prices or shrinking profits. Interest rates, debt, and stagflation risk. As central banks hesitated to cut rates further, servicing $1.5 trillion in AI and data center debt grew more expensive, threatening a cascade of defaults were growth to slow. GDP masking by AI. Analysts warned that headline U.S. economic growth was being artificially propped up by AI infrastructure spending. Subtract the AI CAPEX supercycle, and the U.S. might already have been in or near recession. Falling consumer confidence and weak demand for hardware. Companies like Apple, Amazon Retail, Meta, exposed to the consumer cycle, struggled as growth faltered. Tech's reliance on discretionary spending became a liability. Bottom line. For the first time in years, the tech narrative of unbreakable growth hit a wall, exposing how vulnerable big tech had become to the same economic cycles that plague old world sectors. Segment 5. Bear and bull cases. It's not all doom and gloom. So how did individual stalwarts fare? Let's run the bear and bull cases for 3 bellwether names, Tesla, IBM, and Salesforce, to illustrate the complexities and nuances of trading tech amid a crash. Subsegment 5A. Tesla, embodied AI or burnout narrative. Bear case. Tesla's latest quarter showed revenue down 12% YOY, EPS down 23% YOY, operating income down 42%. Vehicle deliveries fell 14%. Mounting competition in EVs, with new rivals emerging domestically and internationally. High-profile recalls and ongoing negative news about product safety and CEO controversies. Institutional investors reducing stakes, insider selling, and declining market share in core regions. No significant progress on robotaxi or full self-driving proving either commercially viable or regulatory safe. Key bear thesis. Tesla is not a growth company anymore. The EV market is maturing, margins are getting squeezed, and the company's tech edge is narrowing. The stock's PE is still sky high, and ambitious bets on AI-powered cars and robots are speculative at best. If AI hype collapses, Tesla becomes just another car company, at risk of trading at a much lower multiple. Bull case. Tesla is the unrivaled leader in global EV sales and battery tech. Ongoing investments in AI and robotics, e.g., Optimus Robot, FSD, position it for growth beyond cars. New models like the Cybertruck and rumored Model Q target untouched markets. High-profile analyst upgrades and bold targets, e.g., ARK's $2, 600 per share by 2029. Robotics, AI, and energy storage remain major long-term tailwinds, and cost reductions could inflect margins again if macro conditions stabilize. Key bull thesis. Tesla remains an AI ETF in a box. Even amid the crash, it is innovating faster than rivals, and if it executes on automation, ride-hailing, and home robotics, the company could reignite a new growth leg. For believers in the AI-enabled world, Tesla is perhaps the blue-chip trade on that future, assuming it shows discipline and survives the transitional pain. Subsegment 5B. IBM, transformation or treading water. Bear case. IBM remains structurally underweight, a legacy brand struggling for relevance. Near-term consulting/revenue growth slowed, with macro pressures and tariffs forcing clients to pull back on spending. Ongoing debt burden, $63 billion, with increasing leverage despite years of restructuring. Competitive threats from cloud-native firms, Amazon, Microsoft, Google, continue to erode IBM's pricing power and margins. Skepticism over whether AI and hybrid cloud initiatives can offset declining mainframe and legacy business lines. Key bear thesis. IBM is at risk of being the Kodak of IT, unable to transition fast enough despite splashy AI/Red Hat investments. If consulting contracts slow and AI hype fades, cash flows could be pressured and the dividend come into question. Bull case. Third quarter of 2025 showed accelerating revenue growth across software, plus 10%, consulting, plus 3%, and infrastructure, plus 17%. AI book of business exceeds $9.5 billion, with IBM's enterprise AI platforms, Watsonx, Red Hat, gaining traction in key verticals. Raised outlook for 2025, with more than $14 billion in projected free cash flow and a 109-year record of uninterrupted dividends. Strategic repositioning toward hybrid cloud, Red Hat, automation, and industry partnerships delivering resilience amid volatile IT spending. Industry recognition for disciplined execution, margin expansion, and strong balance sheet relative to many peers. Key bull thesis. IBM is no longer just a legacy hardware company. Its disciplined focus on hybrid cloud, cybersecurity, and enterprise AI makes it a quiet beneficiary as large organizations look for stability in a chaotic tech landscape. The stock could re-rate higher if AI proves to be less of a winner-take-all race and more a game of secure, compliant enterprise integration. Subsegment 5C. Salesforce, agentic AI juggernaut or overhyped CRM. Bear case. Monetizing AI is hard. Salesforce's Agentforce platform faces analyst skepticism over whether it can actually deliver meaningful profits. Macro headwinds, tariffs, currency, slower U.S. federal spending, cut consulting revenue, and slow customer upgrades. Fierce competition for Microsoft, Adobe, Meta, and a rising field of feature-rich AI CRM rivals. The high-profile layoffs, fear of margin compression, and a failed track record of integrating acquisitions. Key bear thesis. Salesforce is at risk of slipping from system of record to nice-to-have status in a crowded AI market. Without rapid adoption and clear wins, Agentforce could become a costly distraction, and the company's rich valuation is hard to defend if AI proves more hype than transformational. Bull case. Fast-growing revenue guidance, $41 billion plus in FY26, $60 billion plus by 2030, and accelerating AI-related sales, data cloud, and Agentforce ARR up 120% YOY. Agentforce 360 and robust AI partnerships, Google, OpenAI, Anthropic, poised to automate and unify enterprise workflows. Share buybacks, $7 billion tranche, rising margins, GAAP and non-GAAP, and diversified customer wins, U.S. Army, Dell, Marriott. Salesforce positioned as a platform for future agentic enterprises, companies where AI agents augment or automate most workflows. Key bull thesis. Salesforce eats its own dog food, already using Agentforce to reduce support costs and increase productivity. As AI reshapes how businesses operate, Salesforce could emerge as a core infrastructure player for next-generation enterprises. For investors who believe in the AI plus workflows plus data thesis, the 2025 crash could offer an opportunity to buy a long-term winner as the hype clears. Segment 6, Systemic Risk, the AWS Outages Lasting Lessons. Returning to the October AWS incident, we need to grasp just how profound the implications are. Here's the core lesson. When a single failure, whether a DNS misconfiguration, API outage, or software bug, can trigger a domino effect across 60-plus countries, taking down everything from banks to public utilities to trading platforms, the system is too concentrated. We now face systemic risk, not just from too big to fail banks, but from too centralized to survive cloud infrastructure providers. This isn't just an IT problem. It's an economic and regulatory one. Financial regulators, including the Bank of England and EU leaders, are racing to stress test these critical third parties, recognizing that resilience is not a technical afterthought, but a core national security and economic problem. The wake-up call is clear. Multi-cloud architecture is becoming standard for any institution too big to risk a single point of failure, particularly in finance, healthcare, and government. Regulatory scrutiny will intensify, with operational resilience, data sovereignty, and clear plans for stressed exit or failover becoming mandatory. Resilience by design, through diversified cloud regions, live disaster recovery drills, and redundancy in authentication/data layers, must be prioritized. Systemic risk management is now central to the conversation, not just uptime. Segment 7, Navigating Volatility, the outlook for traders and investors. How should traders and investors respond? Here are the key takeaways as we look ahead. 1. Diversify, de-risk, and avoid concentration at both portfolio and operational levels. The Magnificent Seven are no longer immune. 2. Monitor key inflection points closely. Actual adoption and ROI from AI initiatives. Earnings reports showing real margin expansion, not just top-line growth. Evidence of cash flow discipline amid headwinds, regulatory action, and ongoing debt service costs. 3. Watch for renewed volatility. Big tech may retrace, but select winners, especially those delivering real productivity, not just hype, will reemerge. Expect a longer, rockier recovery curve for many theme and startup tech names. 4. Stay disciplined on valuation and scenario analysis. The future could bring a soft landing, a bankruptcy cascade, or a renewed boom, but this time investors are demanding real proof, not just a good story. 5. Prepare for regulatory and architectural change. As policymakers move to harden critical infrastructure, the landscape for tech risk and tech return will be reshaped. That brings us to the end of today's deep dive episode on the collapse of tech stocks. This cycle is testing every playbook, trader, investor, and tech executive alike. The message is clear. Risk is real, resilience matters, and the next winners will be those who combine innovation with hard-nosed discipline. A final reminder, the content discussed here is for informational purposes only and should not be considered investment or financial advice. Always do your own due diligence or consult a qualified professional before making trading decisions. If you found today's breakdown useful, be sure to subscribe, leave us a review, and send us your questions for future segments. You can find more resources and episode transcripts at. Thanks for listening. Until next time, stay informed, stay nimble, and trade smart.